Hello and welcome. ValleyBiggs is a boutique M&A firm focused on the representation of middle market owners and investors looking to exit their technology companies. Our intermediaries focus on target acquisitions with a purchase price of $1 million and up. Our concentration is specific to the digital space, including technology companies, internet companies, websites, Amazon companies, ad networks, digital marketing firms, software and app companies, and much more. One thing we see a lot when we meet with potential sellers of middle market tech companies is a disconnect between the attractiveness or appearance of the business in the marketplace versus the actual value of the business. There are a lot of considerations we place in packaging and marketing a company. When it comes to buyers, investors, and lending institutions, we know exactly what they are looking for and expecting in a target company. It is our job to make sure they see the things that they want to see, as well as those that are necessary to orchestrate the desire to finance and close the deal. Many brokers fail in selling internet businesses because they simply don't understand the nuances of an internet business. So they miss out on the opportunity to provide the exact information the professional buyer and lending institution needs. We ensure that the important information on the target is in front of the buyer and its investors up front, so that it can see the true value and potential of the business. Having owned and operated dozens of companies, the founders behind ValleyBiggs truly understand the desire to pay absolutely as little as possible in taxes. It is very common to bury profits in the many available line items of the financial statement. It is then assumed that you can tell the potential buyer about all the hidden treasure. This is partially the case. Even though buyers know the cash flow is there, they might not necessarily know how much is there. They will definitely discount the price because of this. Unfortunately, that is only half the problem. When securing financing for a deal, it is the bank or investor and their underwriting teams that will be making the final decision, and they do not consistently allow these add-backs. Lenders will give the add-backs consideration, but this consideration usually does not work out so well for the seller. There is a way to have your cake and eat it too, but only a brokerage with in-depth knowledge of the inner workings of the financing and underwriting will have the know-how to get the job done. When it comes time to sell, lenders and investors usually want to see 3 years of tax returns, income statements, a balance sheet, and all relevant general ledger entries. They put a lot of emphasis on the trailing 12 months in technology companies because many things can change so rapidly in this sector. The latest year leading into the sale must reflect the hidden numbers, because if they don't, the transaction is walking with one foot in the bucket. The previous year needs to reflect a substantial portion of those numbers, and if it is necessary to facilitate the loan with a bank, an amendment will need to be filed for the third-year tax returns in order to bring them in line with expectations. The profit column on the tax return isn't the final step in the eyes of underwriters and investors. It is merely the first. For sole proprietors, which there tend to be a lot of even in the middle market, lenders and investors tend to recognize the following in order to determine a base upon which to utilize the purchase multiple: profit, owner's compensation, interest, depreciation, amortization, pension plans, profit sharing and retirement accounts, and payments to family members. These are well-recognized add-backs and will be factored into the multiple used to value the company. Underwriters will also be semi-lenient with other items, such as a vehicle that is written off or health insurance if the buyer can prove he doesn't need it. If, for example, his wife has it through an employer, etc. If the add-back list becomes lengthy, the bank will become less and less likely to accept these charges as add-backs, so it is important to keep it simple and streamlined. Again, only an experienced M&A advisor like the professionals at ValleyBiggs can walk through this minefield of lender and investor requirements. We've been there over and over again. One thing to keep in mind is that the attitudes of banks change with the economy, even in the middle market. In either an economic downturn or a red-hot overheating economy, they will tighten lending rules and increase the obstacles to lending. In an emerging or stable economy, they tend to become more aggressive in their lending activity. If you are planning to sell your middle market technology or internet company, call us early in the game and we can help you maximize your sales price. Not using an M&A firm that specializes in this sector and that is adept at the game of financing a deal can be a costly mistake. Thank you for listening today, and for additional videos related to our firm, our processes, and our experiences in the middle market, please search for ValleyBiggs at youtube.com.